Having me. It's a good Thursday. One more day to the weekend.
There you go. And we're here to help give you some data. I know Luke's the data expert here. And I'm the perspective expert, I guess you could say, since 20 plus years of investment experience. And our job is to instill a little bit of both and help you become a better investor, take that next step towards financial freedom. And in light of that, at the top of this podcast, I want to make you aware of our webinar coming up. Just less than a week away now, June 28th. That's next Wednesday. Rates in real estate. It's a free webinar, and you're going to gain some valuable insights in commercial real estate, residential real estate for 2023 and beyond. Now, we're also going to look at REITs, and we're also going to have a special guest, Kent Lefevre. He is an expert in deferred sales trusts, and that's going to be an interesting way, if you have a lot of real estate assets, to think about maybe opportunities in other directions in an environment where obviously real estate continues to slow. So we're going to do this at 1 p.m. Pacific time. It's going to be 1 to 2 p.m. Pacific time next Wednesday, and you can register right now on InvestTalk.com. Now, with that said, today's podcast, I'm going to blend my comments with you, the listeners, questions, and you set the table. You're vital to this program because you shape the show. We can talk about whatever is on our mind, but your non-pre-screened live calls are important to really push the agenda. And we're committed to giving you the answers that fit our worldview in regards to the data that we're looking at and the perspective that we have. So we have no hidden agenda. We're just going to give you the best path forward for your investment journey. And we encourage you to do a few things, as always, which is ignore emotions, focus on the task at hand, the data that's in front of you. Don't chase headlines and try to avoid that fear and greed that can creep in really at any time. Now, we're ready, to answer your questions at 888-99-CHART, so you can call right now. Now, our focus point today looks at the story behind this question. How do alternative investments fit into a diversified portfolio? And alternative strategies, as they are aptly named, they give you a fundamentally different type of exposure to assets and strategies, and this can be very different. So alternatives have many buckets, kind of subcategories of alternatives, which we're going to dig into and kind of give you the long and short of how to think about how to gain exposure, if you should gain exposure to the alternative asset sector. Also, we're going to touch on inflation, not just here in the US, but worldwide, and what policymakers are doing about it. Also, Jerome Powell is trying to engineer a soft landing while still fighting inflation. So what type of challenges does that create for him? And then lastly, we're going to look at what was the last one we're going to do? I forget. What was it, Luke? There was one more. Oh, that's what it was. South Korea has overtaken, or the U.S. has overtaken China in imports from South Korea. What does that tell you about deglobalization, regionalizing supply chains? And we're going to look at that story as well. We also have some voice bank questions. One is on portfolio management and MDU resources. So this is what we have planned for today's episode of InvestTalk. Now let's take a look at the market today. The headline numbers were positive. If you look at the S&P, that was up about 16 points. But Luke, the broad equity indices, if you look at NYC, that was down slightly. So we continue this kind of modest pullback after these recent highs. What do you think is really driving this pullback?
Yeah, I think we had quite the run run up in tech, especially. I think there's been a lot of positioning that hedge funds have been kind of drawing down on some of their long positions as well. And I think overall people are just evaluating that the price appreciation, the movement of the market over the past couple of days, over the past couple of weeks, isn't really in tune with a lot of what we're seeing with the higher for longer attitude of the Fed, and potentially shrinking demand both in the country and outside of it.
Yeah, and that second last part I think is most important. Was it this morning or yesterday? Jerome Powell testified in front of Congress and really was even more hawkish in his tone compared to the last Fed meeting. Now maybe that, like you said, is in the face of that strong equity market, but that's what I think really was driving the market a little bit lower. You saw the dollar higher today. And what are the odds for a Fed rate hike at the end of July?
It's upwards of 70%.
Yeah, so that's starting to creep in as well. So I think that's really what's weighing on here. But if you look at it overall, I don't really see anything major from a technical perspective. Like you said, it was a bit overbought. And the S&P actually closed up today. So I think we're hitting up into resistance, and it's expected to at least chop sideways. That's what happened back in April and May. We hit resistance, kind of the levels that we saw in early February that we came off of, and it consolidated before we moved higher. I certainly could see that again because liquidity remains relatively robust, even though rates look like they're continuing to go higher. So interesting little pullback and a modest down day overall, even though the S&P was a bit higher. Now let's head over to our first listener question now.
Hi, Justin and Steve. This is Mike from Detroit. Asking about ticker symbol here, PDI. It's the PIMCO Dynamic Income Fund. Looks like it's a closed-end fund, higher expense ratio. Been on a downtrend here lately for the past few months, likely secondary to the rise in interest rate that the Fed has been implementing. Just wondering what you think would be a good entry point for this closed-ended fund. I'm attracted to the dividend. I think it's paying out a 14% dividend right now. I know there's other things that should be considered, but just wondering what you think a good entry point would be. Thank you.
Well, let's look at PDI, which is the PIMCO Dynamic Income Fund. And you're right, the expense ratio is pretty high, 2.64%. Their interest expense alone is 0.63% because this has leverage. It employs leverage to get that nice, juicy dividend, which is pretty high, 14.3%. And as always, Luke, when something is yielding that high, there's some risk involved here. And it looks like that is in regards to credit risk, right?
Yeah, that's what it looks like.
Yes. Yeah, so about it's still fairly high quality assets. Let me see what it is. 30% government, only 20% corporate, 23% securitized. So it's fairly spread out. That's one thing I like about it, that it's not just focused on one part of the credit markets, but that leverage, that's why it's declined so dramatically, is because the underlying bonds that it has have declined. Let's see, what's its duration risk here?
Interestingly enough, it has 40% exposure to mortgage-backed securities.
40%. Yeah. So, is that commercial mortgage-backed securities or is that residential? I think it's the big question.
That's the big question. I can't really get down into the weeds.
Into the weeds there. Yeah. What I would say is this is just a broad play on bonds. Do you think that the default cycle is going to be pushed off for a while? Do you think that interest rates are headed lower versus higher? Obviously, the last few months, this has rallied a little bit as interest rates have come down, but it really hasn't rallied that much. So that's what worries me the most. Is it trading at a discount or a premium? I think would be my question. Let's see. Pulling that up here. It looks like currently it's at about 7%. Yeah, I would not be buying this right now. I'm not a huge fan of that leverage just to get that 14%. Big downside, as we've seen over the last couple of years, and 14% is not enough to compensate for me. Now we're heading into a quick break. Please remember that you can call anytime and leave your question on the InvestTalk voice bank, or if you're listening via the live stream on AM 1220 in the San Jose Bay Area, give us a call now at 888-99-CHART.
KPP Financial invites you to join us for a new InvestTalk Wealth Webinar, Rates and Real Estate. You'll gain valuable investing insights for the commercial and residential real estate markets of 2023. We will also explore the world of REITs and delve into a comprehensive analysis of the Deferred Sales Trust, a real estate tax deferral strategy. The InvestTalk Wealth Webinar will take place on Wednesday, June 28th from 1 to 2 p.m. Pacific Time. And it will be led by InvestTalk host Justin Klein, along with KPP Financial Portfolio Manager Luke Guerrero. This complimentary webinar is your opportunity to learn from top finance experts in the industry. So go to investtalk.com, register for this free wealth webinar, Rates and Real Estate. Justin Klein is here and ready to take your calls live. InvestTalk, 888-99-CHART.
Hey, Steve or Justin. You guys always say that you should never have one stock be more than 5% of your portfolio. When you say 5% of your portfolio, do you mean of just your stock portfolio, or does that count like your cash and retirement account as well? Is it just your stock portfolio? That everything together, that it shouldn't be more than 5% of? Thank you. I'll listen on the podcast.
I definitely think it's more of your broad investment assets. So if you have an IRA and a 401k, then you can combine those together. For example, I think you put cash separately, and that's kind of its own bucket for emergencies. What do you think, Luke?
Yeah, no, I agree with you. I don't know if I would separate cash. I consider that a part of my asset base as well. But, when you think about the risks that you're taking on with any individual investment, you have to have it in the lens of your overall allocation, right? So if a client comes to us and wants to manage their assets, we have to see everything they have so that you can appropriately diversify, appropriately control for those risks. I think I agree. It's more of a broad view.
Yeah, because it's... if you have a small portfolio, that's 10% of your total assets. If it's 20% in one name, overall you're broadly diversified because you have other assets elsewhere. So yeah, it's definitely out of your overall asset base. All right. Now let's fit in one more question now.
Hi, Steve and Justin. This is Cooper from Oklahoma. Just had a stock idea. Just want to see you guys check it out. It's Paycom. Could you look it over for me and let me know your comments and thoughts? Thanks.
All right, this is Paycom Software, and it is, let's see, how big is this name? About $18 billion. So would you consider that large cap, mid cap?
Mid cap.
Mid cap, yeah. Mid cap's kind of creeped up over
Mid cap,
years.
it kind of creeped up to like the 16 range.
Yeah, so you're borderline here. It used to be, I remember when I first started, it was like 10 billion, anything over 10, but obviously with inflation and inflation of asset prices, 15, 20 billion, that's where you start getting into the large cap space. So, but it's fast growing, obviously. It has revenue growth over the past 2 years, year over year, right around that 30%, almost consistently, almost like clockwork on the sales side. And same with the earnings around that level as well. This year, earnings are supposed to go up 25% and then 21% next year to $9.27. So forward looking, we're talking about a little over 30 multiple. For something growing that consistently, Luke, that's not bad. And I think that it's small enough where you might have more runway for that growth. My always worry is, when does that growth peter out? When does it slow? And it hasn't so far.
Yeah, I mean, it looks to me like their profitability has kind of dropped a little bit from the highs before the pandemic. But, on the other side of that, you mentioned it before, their projected earnings is looking good. They've constantly gotten some earnings upgrades in the past couple weeks. They have very little debt. I mean, these are all good things. Yeah,
definitely. From a fundamental perspective, it is a company that's certainly executing well, both on the profitability side and the growth side, which I like. And so I'm willing to pay a higher than market multiple for something like that. And so around 30 multiple, I think that's okay. And then technically, it's not fantastic, but it's pretty good. So I'm going to give Paycom, if you're looking for the growth side of the market, this is definitely one of those better names that is at least living up to the hype. All right. Now we're heading into a break, so give InvestTalk a call right now at 888-99-CHART.
One of the most rewarding things I do each weekday is host the InvestTalk podcast. I truly enjoy helping investors, and I know that every question counts and every answer I provide will be unbiased. You, the caller, get to chart the course for each InvestTalk podcast. Call with your questions anytime, day or night, 888-99-CHART.
Now let's touch on our main focus point today, and that is, how do alternative investments fit into a diversified portfolio? And as you would imagine, alternative strategies offer something different than your traditional asset classes, your bonds, your stocks, your commodities. And there are a lot of different strategies underneath the alternative asset umbrella. And it's often tough to really decide how to appropriately benchmark them, because remember, these are different. You're not going to ask a horse to act like a dog. They're fundamentally different. And so they're under many different asset or categories, but broadly they are equity market neutral, event driven, option trading, relative value arbitrage, and then multi-strategy, which means kind of a mix of all of them. Now, this is an area where comparing them to some of them you can compare fairly well to equities or other traditional asset classes, and others are completely different. And those ones that are most different are typically equity market neutral. That's typically your long and short funds. Event driven, that would be like M&A arbitrage, and then relative value arbitrage. And so these are the ones that are typically not that sensitive to moves in what's happening in the equity markets. And they tend to, that's because they're not just owning broadly those asset classes and kind of trading around the margins. So there are common ones like covered call strategies that are classified as alternative because they have so much equity in them, it's still pretty correlated. So how do you, Luke, think of alternative strategies, and how do you think investors should think about them?
Yeah, well, I think over short periods of time, I know there's been some changes in correlations relative to the broad market in the past couple of years. But if you look at the long-term correlations, it's pretty consistent, right? You can stably see that there are ways to diversify your portfolio through these types of vehicles that can lead to better investment outcomes.
Mm-hmm. Yeah, and that's really what it is. It's diversification, and most of the time they underperform. But it's the times like last year where most of them that are not really correlated to the market, the ones that I kind of listed off, they either were barely down, some of them were up pretty dramatically. And that's when they earn their keep, right? So last year, for example, alternative categories delivered returns ranging from between positive 16.9% and negative 9.2%. And the S&P was down, roughly 20%. NASDAQ was down about 33%. And so the ones that the ones that are not very correlated with the overall market, at worst they were up 5.9% last year. And like I said, at best they're up 16.9%. So this is something where I want to say it's a rainy day allocation, but it's a diversification mechanism.
Yeah, here's how I think about it. Most years, bonds are going to underperform stocks. Yeah. It's just going to happen, right?
But does that mean you shouldn't own them?
No, it doesn't mean you should own them, because the point of diversification is not only diversifying your risk, but smoothing the investment experience, right? It's about limiting the volatility in a way that helps preserve capital, yes, but also helps you sleep at night.
Mm-hmm. Yeah, and it's one of those things where you have to pick the right strategy for you and your ability to understand that, when you have good years like 2021, right? Equities were up high 20% in general range. A lot of those were not up very much. But then obviously the next year they earn their keep. So, alternative strategies aren't this broad bucket, and they're sold a lot. You get a lot of calls that the fees on them are pretty high because they're typically complex strategies. They're not index funds where you're only getting charged 4 or 5 basis points because those that are running that fund aren't doing a lot of work. They're doing a lot of work to do M&A arbitrage. That can be time consuming, and it takes real thought and understanding where and when to take risks.
I will also say, though, it does lean back on the cardinal rule, which is you should understand what's in your portfolio. And some of these things are a lot more complex, and maybe some people don't want to take the time to understand them, and you shouldn't allocate towards them. But certainly I think there's reason enough to learn about them and see if they fit your portfolio.
Yeah, if I'm going to pick one of these 5 that are not, I guess one of the 3 that are not very allocated, or not very correlated with the overall market, it would probably be the M&A arbitrage. I think that has the best kind of risk-adjusted return. And if you blend something that can diversify the portfolio more with your traditional 60-40 portfolio, the end Sharpe ratio, which is a measure of basically risk versus reward for a portfolio, actually goes up. So I think there is a place for it, but you have to be mentally prepared for underperforming in good years and knowing that you're going to make that back in years where, the traditional asset classes don't do very well like last year.
Yep. Understand what you own.
Exactly. All right. Well, on the next InvestTalk, the story behind this story. A billionaire investor says the U.S. entered debt crisis with shortage of treasury buyers. And the estimation is based on the fact that institutional investors who bought treasuries a few years ago were ultimately hurt by the Fed's rapid interest rate hikes. Steve will get to that story tomorrow, but for now, I'm Justin Klein with Luke Guerrero, and I'm ready to take your questions live at 888-99-CHART.
KPP Financial invites you to join us for a new InvestTalk Wealth Webinar, Rates and Real Estate, June 28th. From 1 to 2 p.m. Pacific Time. You'll gain valuable investing insights for the commercial and residential real estate markets of 2023. So go to investtalk.com, register for this free wealth webinar.
Let's go talk to Taylor in Minneapolis, and he has a portfolio management question.
Hey, Justin. Yeah, I've got a question about just evaluating your own personal portfolio. I know that the Dow is only made up of 30 stocks, and the S&P 500 is made up of the top 500. When comparing my portfolio to the S&P 500 over the last 6 months, I've only made a measly 2% on my portfolio, and the S&P 500 is up 14%. So I'm just curious to know if there's a better way to evaluate my personal portfolio or how you go about doing that.
Yeah, hey, this is Luke here. That's a great question because I think, one of the things people struggle with is benchmarking their portfolio. And part of that is understanding what makes up those benchmarks. So the S&P 500 is actually not the top 500 companies in the U.S. market, but just companies that are selected from the Standards & Poor's Committee. And so that's how they make up that benchmark. So if you take a look at the S&P 7, for example, the 7 handful of names this year, it's up like upwards of 20%. But if you take a look at the other 493, it's only up about 3% this year. And that's really indicative of the overall market. So, if you're taking a look about, it's called breadth. Yeah. If you're taking a look at, how you should benchmark your portfolio, if you have a diversified, portfolio of U.S. equities, for example, then you want to find a diversified U.S. index. The Russell 3000 is a great one. It takes a look at the top 3,000 companies, and it gives you a more accurate representation, of what is happening in the U.S. market.
Yeah, I completely agree with that because at any given time, there's what is called style drift. And especially in those market cap weighted indices like the S&P 500. And it basically means that the larger names, they have a bigger weight. So if for right now, the tech industry is the highest weighting within the S&P because they just tend to be valued the highest. But that isn't always the case, right? There have been periods where, kind of pre 2008, the oil sector, Exxon was the largest holding within the S&P. And so it varies. And so does that mean that you want to benchmark something where maybe you're way underweight tech? And should you be benchmarking towards an index that's overweight tech? Probably not. You want something that's a lot broader, and that's I agree with Luke. Something like the Russell 3000. That's why I look at the NYSE, for example. That's 2,500 different names. That's going to give you a much better representation. Ideally, you probably want you want to create your own benchmark if you can, probably with your sector weightings, right? So there's your understanding, are your energy stocks outperforming the energy stocks within that sector, within the market? Are your industrial stocks outperforming the industrial stocks within the market? That's the way I would probably look at it, more than the portfolio in aggregate. So it's definitely difficult to benchmark because you want to be comparing apples to apples, and by nature, all portfolios are just a little bit different. Okay. Let's go to Sid in North Carolina and wants to talk about Liberty Energy.
Hi, Justin. Good evening. Thank you for your time for picking up my call. And I do have this stock in my radar for last few days, and I'm thinking it looks like a good one, but I don't want to get trapped just because it's cheap. I'd like to hear your viewpoint, and if it's a good entry point, please do advise. Thank you.
Okay, well, looking at Liberty Energy, and this is in the oil services area. It's one of the largest pressure pumpers in North America. A pretty decent size, $2.2 billion, so small cap name. And it does look cheap, Luke. Very little debt, and its business is pumping, right?
Yeah, it's taken a turn on profitability for the upside in the past couple of years.
Yeah, and the question is that sustainable? So if you look back 2017, 18 pre-pandemic, it had negative free cash flow, and suddenly earnings are expected to go from only 68 cents back in 2020 all the way to $3.70 next year. But it looks like analysts are downgrading those expectations, right, Luke?
Yeah, and I think a lot of that has to do with the fact that energy companies in general are just going to go within the trend of whatever the commodities market's doing.
Yeah, actually, I was looking at the wrong name. Sorry, Liberty. Yeah, they were losing money in 2020 and 2021 and 2016. Supposed to be $3.56 next year at $12.75. That's a 4 to 5 multiple. Mm-hmm. That's pretty cheap. But here's my worry and my wonder: why is it underperforming the oil services sector so much? Okay, this is in a clear downtrend. Okay, it's below all the major moving averages after today, 50, 100, 200-day moving average. And if you look at OIH, the oil sector, the VanEck Oil Services ETF, that one's above the 50-day moving average, barely below the 100 and the 200, and it is still in a general uptrend. So that's my main question, Luke, is why does it continue to drastically underperform its peers?
Yeah, I mean, for me, it could be a debt story. It does have little relative debt, but if you look at its relative to its market value, rather, but if you look at its debt relative to what it's actually earning, I mean, its interest rate coverage ratio is 22%. Profitability metrics are one thing, but they do still matter in a nominal sense when it's relative to your debt. So, that could be one of the reasons why is when they've been struggling for a while to service that debt from their earnings. That
and the market's kind of pricing in that maybe this profitability is more of a flash in the pan type of thing. And so I would be looking for a name. I wouldn't be just too caught up in the fact that it's cheap. There are a lot of cheap names in the oil space. I would want one that has a longer track record of strong profitability. And this, to me, is just too near term, and I worry that it might be, once again, a flash in the pan. Let's go to Nick in Manhattan Beach, who wants to talk about Charles Schwab.
Hello, Justin. Yeah, so I believe this company is a little bit undervalued. I think it took a bath with the regional banks back in March and hasn't quite come back to where I think fair value is. Operating metrics, profitability, gross margin, recent revenue growth, net income growth, all pretty healthy to me. Stocks trade on forward earnings, and it looks like they're going to make around $4 to $4.20, $4.30 next year. And so to me, I think they're undervalued because they're at an all-time low price to earnings ratio, price to book ratio. And let's just say, it's trading at a 14.5 P right now. Typically, it's traded in the low 20s, mid 20s. If we were to ascribe a $4.30 earnings per share to just a 20 P ratio, that's $86, and it's currently trading at $53. So I think it's a good price to pay right now. What do you think?
Well, what you're talking about are earnings and multiples, and with Charles Schwab and any of these financial institutions that own a lot of longer-term debt, longer-term treasuries, excuse me, there is that issue of marking those assets to market. So a lot of the regional banks that went under, their earnings going forward, expectations and over the last year looked pretty good. But obviously they were structurally insolvent. And when there was some sort of run on that bank, then they suddenly had to realize those losses. So that's really the issue here with Schwab, is there are a lot of losses underneath the surface. And the question is, will there be a run on Charles Schwab and to force them to realize some of those losses? And I think ultimately that is the biggest risk here, and why it remains kind of down here in the high 40s, low 50s range for the past few months. So that's what you have to really decide on, because you're right. I think it's cheap, but will those risks underneath the surface rear their ugly head? What do you think, Luke?
Yeah, no, I agree with you. I think that companies like Charles Schwab took a hit in the regional banking crisis in a way in which maybe wasn't warranted. They certainly do have those duration issues that you mentioned, but given that we still may be in a position where we don't fully know the scope of the issues caused by the Fed with those rate hikes, and with more hikes potentially down the road as well, the risk is definitely there. But it's a company I've been looking at.
Yeah, we've been looking at this as well. I just want something from a technical perspective that is telling me this is out of the woods. And I'm not seeing that yet. It's, when something moves down, I've talked about this a lot. This is the most basic of understanding of reading charts. It's a consolidation pattern where there's a range that it trades in for a period of time, an extended period of time. And usually its next move is just a continuation of the previous move. And that can be bullish, right? You saw that the S&P, it had a move higher in the month of, month of March into early April, and it consolidated for April and pretty much all of June. And then we broke out, all of May. And then we broke out here in June. So that's a bullish consolidation. Whereas right now with Charles Schwab, you have what's called bearish consolidation, which a lot of these regional banks have. So I don't think that, and that just tells me that underneath the surface, the duration risk that we just spoke about is still there. If that goes away at some point, and this could just be a bet on lower interest rates. If you think interest rates are going to be cut, I think these are great names to own. But as long as the Fed keeps jawboning higher for longer, and there isn't any imminent near-term cut in interest rates, I think this is going to, at best, languish here and could take another stair step lower. It doesn't mean it has to go bankrupt or become structurally insolvent, but it may have a stair step down.
Yeah, I agree. You also got to be cognizant that sometimes in this situation where they want to be higher for longer, the cut comes after the calamity, and the calamity would be bad for prices in these types of companies. Yeah,
exactly. I think that's the biggest worry here in the markets is, what is that next shoe to drop that will actually get the Fed to cut? We look at the last banking crisis in March that precipitated all this, and that caused them to launch, was it BTFD? What was it? I forgot the acronym, but basically, hey, give us your assets that are underwater and we'll mark them to market and you'll be fine, and you don't have, and we'll give you the par value. And that kind of solved a lot of the problems for those regional banks and papered over the issues. It raised the Fed's balance sheet, so brought more liquidity into the market, and that was ultimately a mini easing event, despite the fact that they're raising interest rates. I think that's something that most people don't understand, is they think all monetary policy is interest rates. It's not. It's interest rates as well as their balance sheet and how much liquidity they're putting out into the market. And so, what is that next event that will cause the Fed to maybe pause QT, to cut interest rates? And like you said, Luke, that could be a calamitous event that pushes Schwab and the other regional banks another leg lower. So definitely keeping this on the watch list, but still on the sidelines for now. All right. Now let's touch a bit on the impetus for the Fed rate hikes, and that is inflation. And this is an issue not just here in the U.S., although most people probably think it's just a U.S. phenomenon, especially if you are tied into politics. But across the world, central banks are lifting their interest rate forecasts, and as well as interest rates in general. Their inflation forecast, as well as their interest rates. Now, here in the U.S. and in Europe, inflation still is right around 5% or higher in some countries, and this is without the tailwind of energy and food prices. Energy and food prices have been down over the past year, and that's that base effects issue. Wage growth is stabilizing, and you're starting to see this problem of persistently high inflation really worldwide. And I think, Luke, the question will be is, how do central banks really fight inflation while not creating that hard landing?
Yeah, it's difficult because in the U.S. we have been making a lot of progress. I know in Europe there hasn't been as much, but there are some things the Fed did to restrict credit markets with raising rates that did help with a little bit. But the things that helped for the most part were energy prices coming down and grocery prices going down, right? There's nothing the Fed could do to solve the fact that gas was really expensive. And that's one thing everyone feels. There's nothing the Fed could do to solve the fact that some avian flu hit a crop of chickens. The chickens, they eventually got the production back up. So,
well, and the Fed's always monetary policy is all about ramping up demand, higher or lower.
Yeah,
You
exactly.
can't really do anything about supply.
Correct. So, when you have a situation like that, where in a lot of countries, around the world, the variables are exogenous in terms of what's actually creating the inflation, I think it's just a situation where the banks get trapped in having to raise rates to prove to the markets that they're trying to beat inflation, whether or not it actually does anything.
Yeah, I think they're trying to walk that tightrope of whether they know there's long and variable lags. Now, they'll argue that actually their impact on the economy is more immediate than it has been in the past because they use forward guidance, whereas in the 90s, they didn't do that, right? They would show up and they'd say, hey, we're raising interest rates 50 basis points, and suddenly short-term rates would move. Whereas now they jawbone it going forward, and it kind of gradually gets there well ahead of time. So I would kind of agree with that, but I still think there's the variable lag to this. And what's interesting here, and this is that housing data as of late, is that in some ways, this, at least domestically, because of 30-year fixed rates, it's actually helped the housing activity, right? Labor markets, because home builders are still building. So it's kind of a paradox that they're dealing with. So, well, this is InvestTalk. I'm Justin Klein. We have one goal here, is to help you achieve your own version of financial freedom. And our work continues after this final break. So get your questions in now at 888-99-CHART.
KPP Financial invites you to join us for a new InvestTalk Wealth Webinar, Rates and Real Estate, June 28th, from 1 to 2 p.m. Pacific Time. So go to investtalk.com, register for this free wealth webinar, Rates and Real Estate.
Hello, this is Sam calling from Dallas. My question is about Verizon or Walgreens, which is WBA. These two dividend stocks are actually down as of today. So I wanted to know, what are your views on these two stocks? What is the future? Because I think they pay a very good dividend, and I think they are a very good long-term buy if someone would like to invest. So if I'm looking at a horizon of, let's say, 5 years, would you give your approval if someone would like to buy these two stocks today in large quantities and just keep them? Thank you.
Well, my first issue here is that you're filtering based on dividend. They have high dividends, but does that mean that they're good investments? Not necessarily. So they can be. They certainly can be. But I wouldn't buy them simply because they have a high dividend yield. And I think the biggest issue here for both of them would be the debt load. So can they sustain the debt that they have on their balance sheet? And will their profitability return to something that is attractive? Now, right now, the return on equity for Walgreens is negative 13%. Verizon is 24% positive. So, and historically, on average, the Verizon return on equity tends to be much higher, especially since 2000 and let's see, what was this date? Post 2013, so last decade. It's been structurally a much more positive business. So if I'm picking one or the other, I'm picking Verizon, right, Luke?
Yeah, but at the same time, the problem with Verizon is the cash flows remain consistent, but its profitability has just shrunk. It's forward
but at least it's high still.
Yeah, no, it's still high. It's certainly high. Yes, if you have to choose between the two, choose the positive. But even if we're talking about, because we don't have to invest in either here.
Yeah, exactly.
Verizon as a company has kind of had some shrinking market share. Its earnings outlook is not great over the next 3 quarters. It's been pretty weak relative to the Russell 3000.
Yeah.
Maybe buy it, but not now is what I would say.
Yeah, exactly. So, it's one of those things where you're really comparing apples to oranges as well. You're talking
Correct.
about a company that owns a suite of drugstores and one of the behemoths within the wireless industry here in the U.S. Basically a triopoly, would you call it?
Let's go with it.
Let's go with it. Yeah.
Triumvirate.
Between AT&T, Verizon, and T-Mobile. So I definitely think I'm going Verizon over Walgreens here, but you have to keep in mind that there is heavy debt loads on both. And if I'm picking one to maintain that debt load, it's definitely Verizon.
Yes.
All right. Now, lastly, let's touch a bit on a new recent trend in regards to global trade, and that is between 3 of the largest countries by economic size in the world, and that would be the U.S., China, and South Korea, especially if you're talking about the tech space. Now, goods exports from South Korea to China fell 10% to about $122 billion from 2021 to 2022. And to the U.S., it actually increased 22% over the same period to $139 billion. So the imports into the U.S. are now higher than imports into China, or I guess you should say exports to the U.S. and exports to China from South Korea. And to me, Luke, this is a very strong indicator that companies are investing more in production here in the U.S. versus China. Because remember, Korea produces a lot of high-value goods, semiconductors mainly, and if they're exporting it here to the U.S., that's to go into end products, and that means our manufacturing base is growing a lot faster, I think, than the China's.
Yeah, I would agree with that. I think I wouldn't jump to too many conclusions, though, because we don't know if it's on like the internal supply chain side or if it's on the demand side or what's really driving it. I think it's too early to tell that. But from a geopolitical standpoint, it's certainly good for the U.S., who has been trying to get a stronger foothold in Asia. Mm-hmm. And as we've known historically, trade tends to lessen conflict. So being a better trading partner, a bigger trading partner with South Korea kind of strengthens our hand in a time where we're trying to reopen and warm up relations with China.
Yeah. And in the first 3 months of this year, Korean exports to China fell another 20%.
Jeez.
And fell below 20% of the total of Korean exports for the first time since 2005. That's the difference there. But still, continues to weaken this year. This is, I think, also another kind of shot across the bow to China to say, hey, stop stealing our IP. Because that's really what South Korea's, their bailiwick is, which is high-value goods, and they don't want China, which is trying to move up the value chain, to continue to move in that direction on the back of South Korean companies. So I wanted to highlight that because I think it's important to look at those little things underneath the surface that really back up our thesis that deglobalization continues to move along at a fast pace. Now, I'm Justin Klein, and along with Luke Guerrero, and this completes another InvestTalk program. Steve and I thank you for listening. We encourage you to tell your friends and family about our free podcast downloads, which you can find anytime at iTunes, Spotify, or Google Play. And you can rate and review on iTunes as well. Now, it's official. We've now surpassed the 53.3 million podcast download mark since it all began. So thanks to you, and mark your calendars, June 28th, our new wealth webinar, Rates in Real Estate, and you can register on investtalk.com. Independent thinking, shared success. This is InvestTalk. Good night.
InvestTalk is a trademark of KPP Financial. Because of the nature of the interactive dialogue inherent in the format of this program, it's important for the listener to understand that not all comments made will apply to them. Specifically, nothing said shall be taken to be investment advice, or shall statements on this program be considered an offer to buy or sell security. Because such advice is rendered solely on an individual basis and at times will require that the investor review a prospectus before investing. InvestTalk